Have you ever wondered what it really means to be a dominant player, especially in a huge growing market like India, when you're talking investments? Sometimes you just want to get the gist right, understand these big financial companies quickly without getting lost in, well, loads of jargon. So today, that's exactly what we're doing. We're taking a deep dive into ICICI Prudential Asset Management Company Limited, IPAMC for short.
Right. And our goal here is to really cut through all that complexity. We've gone through a whole set of sources, a detailed fundamental analysis included, to unpack IPMC. We're looking at their business, their financials, how they plan to grow, the risks involved, basically giving you a clear, concise picture of this financial giant. We want to pull out the most crucial bits, the things you really need to know to understand where they stand and, their potential going forward.
Okay, so dominant player, massive market. Let's start at the beginning, though. What exactly is IPMC? What's their role in the Indian financial world?
Well, at its core, IPAMC is the investment manager for the ICICI Prudential Mutual Fund. That's their main gig. But they do a lot more. They also handle portfolio management services, that's PMS, and alternative investment funds, AIFs, plus advisory services for offshore clients.
So not just mutual funds then. It's a pretty broad scope.
Exactly. It's quite diversified. They cater to a whole range of investors from, individuals putting away money for the long term to big institutions. It stops them being reliant on just one thing.
Okay, that makes sense. So the big question then, how dominant are they really? Are they just one of the pack or a real leader? Got any numbers for us?
Oh, they definitely lead. The figures, as of March 31st, 2025, are quite telling. They are the largest AMC in India by active mutual fund assets under management. QAAUM is the term. They hold about 13.3% of the market share there.
13.3%. That's significant.
It is, and it gets even more striking in specific areas.
Yeah.
Take equity and equity-oriented schemes. They have a 13.4% share. And for equity-oriented hybrid schemes, well, they dominate that space with a 25.3% market share.
Wow, a quarter of the market in hybrids. Is that mainly institutional money, or do they reach everyday investors too?
That's another key point. Their reach with individual investors is actually unparalleled. They have the highest individual investor monthly average AUM, MAAUM at 13.8%. And even in specialized areas like discretionary PMS for non-corporate clients, they're the largest, managing around 183 billion rupees.
So huge reach, top spot in key areas. This scale must give them serious brand recognition, right? And a massive distribution network.
Absolutely. That scale feeds directly into brand strength and their ability to distribute products far and wide across India.
Okay, that paints a clear picture of market leadership, but does that scale translate directly into, financial muscle? What's the initial glimpse we get from their numbers?
Yeah, the financials look pretty robust based on the summary. Total income, for instance, grew quite dramatically. It went from about 28.4 billion in FY23 to nearly 49.8 billion in FY25.
Almost double in 2 years.
Pretty much. And profit after tax, the PAT, saw similar growth, jumping from roughly 15.2 billion to 26.5 billion over that same period.
And what about efficiency? How well are they using their capital?
Very well, it seems. The return on net worth, or RON-W, climbed impressively from 70% to 82.8%. That's quite high. Plus, a key point, they're debt-free.
Debt-free, wow. Okay, strong start. Now let's dig into how they actually make money. You mentioned they manage vast sums. How does that turn into revenue? Is it mostly fees?
Overwhelmingly, yes. It's driven by management fees.
Yeah.
They charge a percentage on the assets they manage across mutual funds, PMS, AIFs, offshore advisory, all of it. In FY 2025, something like 94% of their revenue from operations came from these fees.
94%. So their fortunes are really tied to that AUM then?
Very closely tied. It means their financial health is quite sensitive to anything that affects AUM. Market downturns, big investor redemptions, even competitors cutting fees.
Right, that would directly impact their revenue and profit.
Instantly. It's the nature of the business model.
Okay, so that fee dependence is clear. But what gives them an edge? Why do people entrust their money to IPMC over others? What are their key competitive advantages?
Well, they have several distinct strengths.
Yeah.
First, as we discussed, the market leadership and sheer scale. Being the biggest isn't just bragging rights. It brings real economies of scale. They can absorb fixed costs like tech upgrades or regulatory stuff more easily than smaller players. And it gives them, better bargaining power with distributors.
Makes sense. What else?
Second, that strong promoter backing. Having ICICI Bank with a 51% stake pre-offer and Prudential with 49%, that's huge. It provides instant brand recall and, crucially, access to ICICI Bank's massive branch network all over India for distribution.
Right, leveraging the parent company's reach. That's powerful. Any other key strengths?
Definitely. Third is their experience management and investment teams. You've got people with an average of 11 years at the company and 25 years of total industry experience. That's deep knowledge. Plus, they have a dedicated in-house research team. Stability and expertise are key there.
Experience counts.
Fourth, their diversified product range. They offer everything from equity and debt to liquid funds and more specialized things. This spreads the risk. They aren't betting the farm on one asset class. And finally, a really robust risk management framework. It sounds technical, but it basically means multiple layers of checks and balances, independent teams watching over things. It's crucial for trust and stability.
Okay, solid advantages. Scale, backing, experience, diversification, risk control.
Exactly. Though it's worth noting, while the promoter backing is a strength, it does create a bit of dependence. If something negative happened to the wider ICICI or Prudential brands, it could, indirectly splash onto IPAMC.
That's a fair point. Okay, let's really get into the numbers now. We touch on the growth. But can you walk us through how their financial performance has actually evolved over the last, say, 3 fiscal years?
Sure. So that total income growth we mentioned earlier translates to a compound annual growth rate, a CCR, of about 32.2% between FY23 and FY25. Pretty strong. And importantly, revenue from operations grew at a similar pace, showing it's the core business driving things. Profit before tax and profit after tax also showed that consistent, strong upward trend. Peak nearly doubling, as we said.
Impressive top line and bottom line growth. But what about margins? Did they become more profitable as they scaled, or did costs keep pace?
This is actually one of the most interesting points, their operating margin. It stayed remarkably stable at 0.36% across all 3 years, FY23 through FY25.
Stable, even with revenue almost doubling.
Exactly.
Yeah.
Which suggests, well, either a highly efficient cost structure or some serious operational leverage kicking in. They scaled revenue without proportionate increases in operating costs. It's quite efficient.
Okay, that is interesting. Very lean.
And then there's that return on net worth. The RONW, we mentioned it climbed from 70% to 82.8% in FY25.
Which you said was high.
It's exceptional. To put it in perspective, many of their listed peers are operating in the 16% to 32% RONW range.
16 to 32 versus 82.8.
Yes, it signifies an incredible efficiency in generating profit from shareholder equity. It really stands out.
That's a huge difference. Okay, so they're making good profits efficiently. How does that translate into cash? What does their cash flow statement tell us?
Well, the cash flow from operating activities reflects that profitability. It grew consistently from about $14 billion in FY23 to over $25.7 billion in FY25. So strong cash generation from the core business.
Solid. What about investing? Are they putting money back into the business?
Yes, and there was a noticeable jump in FY 2025. Net cash used in investing activities was over $5 billion. A big chunk of that, about $4.1 billion, was a one-time strategic investment setting up a new corporate office.
Ah, so a major infrastructure investment. Sign of confidence in the future.
You could certainly read it that way. It suggests planning for further growth and scale, not just routine capital expenditure.
And financing activities, you mentioned they're debt-free, so presumably no loan repayments.
Right. The cash flow from financing is consistently negative, meaning cash is flowing out. And that's primarily due to substantial interim dividend payments. For example, they paid out ordered $20 billion in dividends in FY 2025 alone.
So they're returning a lot of cash to shareholders.
Exactly. They have a stated policy of paying out 60% or more of their profit after tax as dividends. It signals a mature, cash-generative business focused on shareholder returns.
Okay, that paints a clear picture of cash flow.
Yeah.
Now, shifting to the balance sheet, what does that tell us about their underlying financial health and stability beyond just the income statement?
The balance sheet shows steady growth in total assets, from around $28 billion to nearly $44 billion between FY23 and FY25. Financial assets, particularly investments, make up the biggest portion, which makes sense given their business is managing assets.
Right, reflecting the AUM growth.
Precisely. And you also see that increase in non-financial assets in FY25, which is mainly that big corporate office investment coming onto the books.
And on the other side, liabilities.
Liabilities also increased, mostly driven by higher trade payables and things like employee benefit obligations. Pretty standard stuff as the company grows. But the real headline on the liability side, or rather the lack of it, is that debt-free status we mentioned. As of March 31st, 2025, they reported no indebtedness.
That really stands out. Gives them a lot of flexibility, I imagine.
Huge flexibility
Mm.
and resilience. It's a significant strength. Liquidity-wise, while cash levels fluctuated, they state their current cash and liquid investments are more than sufficient for their needs.
Good to know. So, overall capital management, strong equity growth through retained earnings, plus that high dividend payout. Are there any other sort of corporate actions investors should be aware of?
Yes, there's a very important one, particularly for anyone looking at the stock. There's a proposed bonus issue. They plan to issue 1.8 new equity shares for every one existing share. This will dramatically increase the number of shares outstanding from about 176.5 million up to 494.2 million.
Okay, almost tripling the number of shares.
Alongside that, they also did a subdivision, splitting the face value of each share from 10 down to euro.
Right. So what's the key takeaway for an investor looking at, say, historical charts?
The crucial thing for you, the listener, is to understand this will mechanically reduce all the per-share metrics. Earnings per share, EPS, net asset value, NAV per share. They'll all look much lower after the bonus issue.
Even though the company's overall value hasn't changed just because of the share split and bonus.
Exactly. The total pie is the same, just sliced into many more smaller pieces. So if you're comparing post-bonus per share numbers to pre-bonus ones, you have to adjust, normalize the historical data. Otherwise, it looks like performance has dropped off a cliff, which isn't the case.
That's a vital point. Thanks for clarifying. Anything else on the capital front? Commitments? Contingencies?
Just briefly, they have modest contingent liabilities, which are potential obligations, and also growing capital and investment commitments, which aligns with their stated growth strategies. Nothing looks out of the ordinary there.
Okay, so strong foundation, clear capital return policy, but that bonus issue needs careful attention. Let's look forward now. What are IPMC's actual strategic plans for future growth? Where do they see the opportunities?
Their strategy is quite multi-pronged. Firstly, there's a relentless focus on investment performance. The goal is always to deliver returns, using disciplined processes, their own research, and active management. And they seem willing to prioritize long-term performance over short-term gains. Remember that decision in March 2024? They actually suspended lump sum investments into their mid-cap and small-cap funds.
Right, you mentioned that, because valuations are too high.
Exactly. They felt the market was overheated in those segments, so they put investor interest first, even though it meant potentially slower AUM growth in the short term. That builds trust.
Good example. What else is in the growth plan?
Second, expanding the customer base. They're using multiple channels for this. Big push on digital and direct-to-consumer, using data analytics for targeting, making onboarding easier online and through apps. They're also strengthening ties with existing distributors and, of course, leveraging that huge ICICI bank branch network for selling products and training bank staff. Plus, focusing on specific high-growth regions within India.
So leveraging tech and partnerships makes sense.
Third, a major strategic push is growing their alternates business. That's the PMS, AIFs, and offshore advisory we talked about. These often have higher margins than plain vanilla mutual funds. So scaling this up, both organically and potentially through acquisitions like the proposed transfer from ICICI Venture, is key for diversifying revenue and boosting profitability.
Moving into potentially more profitable niches. Okay.
Fourth, continuing to diversify the product portfolio itself. Launching new types of mutual funds to meet changing investor needs. Things like thematic funds. They launched an EV and New Age Auto ETF, an innovation fund, smart beta ETFs, staying relevant.
Keeping the product lineup fresh.
And fifth, international expansion. They've got the green light from SEBI to set up in IFSC Gift City. The plan is to launch retail schemes, ETFs, AIFs, PMS, and advisory services there for offshore clients. They're also setting up in DIFC, Dubai, targeting NRIs and other international investors. This geographical diversification is important, reduces their dependence solely on the Indian market.
That's quite a comprehensive plan: performance, distribution, alternates, products, international. What about the team leading this? You mentioned experience earlier.
Yes, the leadership team's experience is definitely a core strength. Average tenure over 25 years in finance. Key figures like the MD and CEO and the CIO have been with IPMC for a long time. This provides strategic continuity and helps embed a strong culture. And they seem focused on developing and retaining talent below the top level, too.
Okay, strong plan, experienced team. But no company is risk-free. Even a leader like IPMC must have things that, keep them up at night. What are the key challenges and vulnerabilities?
Absolutely. A balanced view is crucial. We can group the risks internally, operationally. Investment underperformance is always number one. If the funds don't do well, AUM drops, fees drop. Simple as that. Managing their rapid growth effectively and actually executing all these strategic initiatives is another challenge. There's also reliance on third parties, distributors, custodians, tech vendors. If one of them fails, it impacts IPMC.
And in today's world, cyber risk must be high on the list.
Hugely important. Online fraud, cyber attacks, phishing, hacking, ransomware are major threats. A breach could be devastating financially and reputationally. Tied to that is data privacy. Protecting investor data, complying with laws like the new Digital Personal Data Protection Act. It's complex, and the penalties for getting it wrong are severe.
What about people risks?
Yes, employee attrition is notably high. It was 26% in FY25, and even higher in the previous 2 years. Holding on to key talent is a constant battle, and related to that is the risk of employee misconduct or fraud. Plus, there's concentration risk if a large chunk of AUM is in funds focused on one specific industry, and that industry hits trouble, it can disproportionately hurt.
Okay, those are significant internal challenges. What about external factors? Market stuff, competition?
Externally, they're obviously very sensitive to the health of the Indian economy and stock markets. A downturn directly hits their AUM and fees. Competition is fierce. Lots of players, big and small, domestic and international, all fighting for AUM. This can lead to pressure on fees and potentially erode market share.
And that dependence on the promoters you mentioned earlier.
Right. While the ICICI and Prudential brands are strengths, any reputational damage to idle parent could negatively impact IPMC by association. And then you have broader risks. Political instability, natural disasters, health crises like COVID-19 showed us, things largely outside their control.
Okay, market, competition, brand association. What about regulations?
Very significant. Asset management is a highly regulated industry. Breaching SEBI rules could lead to fines, restrictions, even license cancellation in extreme cases. Just maintaining all the necessary licenses and approvals is an ongoing task. And like any large company, they face outstanding legal proceedings involving the company, directors, or promoters, which carry inherent risks.
And finally, for our listeners interested in the potential IPO, any specific risks related to that?
Yes, a few key ones. Firstly, as we touched on, the IPO is an offer for sale. This means the company itself gets no money from the share sale. It all goes to the existing shareholders selling their stakes.
That's important. It's not raising capital for the company's growth.
Correct. Also, post-listing, the stock exchanges might impose surveillance measures like ASM or GSM, which can affect trading. There are restrictions on withdrawing bids for certain investor types during the offer. There's no absolute guarantee of getting listing approval on time, and any future share issuances by the company could dilute the holdings of existing shareholders. And for non-resident investors, Indian taxes on capital gains and dividends apply.
Okay, a comprehensive look at the risks. Thanks. So finally, let's talk valuation. We've heard about the strong performance, market leadership, but also the risks. How does IPAMC stack up when you think about its value compared to peers?
Well, the exact offer price and resulting PE multiple aren't set in stone yet, based on the draft prospectus. But the analysis points to some key valuation factors. The absolute standout metric, the aha moment really, is that return on net worth. That 82.8% in FY25, it just blows the competition out of the water. Their listed peers are mostly in the 16% to 32% range.
That massive efficiency gap again.
Exactly. It demonstrates exceptional ability to generate profits from the equity base. And it's not just Ron NW. Their total revenue from operations, nearly $49.8 billion, and their diluted EPS of under 50.2. Also the highest among their listed peers.
So top of the class on key metrics like RON W, revenue, and EPS. Given all that, what does it suggest about how the market might value IPMC? Should we expect a premium?
Based on these fundamentals, yes, the argument for a premium valuation is quite strong. You've got market leadership, that incredible RON W, consistent strong financial performance, the debt-free balance sheet, clear growth plans in promising areas like alternates and international. So despite the market risks we discussed and the lack of a formal trading history pre-IPO, its fundamental strengths are compelling. A valuation reflecting a premium compared to its peers seems, well, quite likely. Connecting it all back. IPMC really does look like a high-quality operation in the Indian asset management space. They've built a strong competitive position, a moat if you like, and backed it up with impressive financial results. Their strategic focus on growth areas, those higher margin segments, digital global reach, it points towards a clear path for continued expansion. The risks are definitely there, but they seem to have solid controls and an experienced team managing them.
So what does this all mean? For you, the listener, getting under the hood of a company like IPMC isn't just about crunching numbers. It's about seeing how a dominant player navigates a really dynamic market, how it balances growth with risk, innovation with stability, and maybe a final thought for you to chew on. IPMC has made these big strategic investments, the new corporate office, the push into Gifty City and Dubai. How do you think these kinds of moves, these capital outlays and new market entries might reshape their efficiency and their market dominance over the next, say, 3 to 5 years, especially when they're also committed to those high dividend payouts? What could be the real game changer for them down the road?